every single company from the Magnificent Seven just delivered a double earnings beat for the first quarter. But the fundamental reality between them is pretty different. So if you are investing today based on surface multiples or trailing numbers, you might be walking into a trap. I just compared all 7 names with a strict framework across earnings quality, growth, capital returns and valuation to find out which one is really the best. And the result actually surprised me, because 6 of these businesses failed at least one pillar. And one crowd favorite looks incredibly cheap on the surface, but is masking quite a significant cash drain. So let's see which of the Mag 7 companies is really the best after the last earnings season. And if you're new here, my name is Florian and I'm a physics engineer and have worked in the semiconductor industry for over a decade. Welcome to the channel and thank you for joining me today. So first, to rank all Mag 7s properly, we need an objective framework that completely strips out the noise. No hype, no macro guesswork, and no tracking of short-term price momentum. I would like to look at the pure operational numbers today. So I have decided to rate all 7 companies across 4 distinct pillars. First up is the earnings quality. Here I will look at how the companies performed against analyst estimates in their last earnings call and how their operating margins and free cash flow margins look. Because accounting profits don't mean anything if they don't convert to hard cash. The second category is growth outlook on a forward-looking basis. Here I will check what the current growth is and compare it to the historical growth rates to see if the growth is picking up speed or slowing down. Third, we have the balance sheet and capital return. Basically, how effective the management is in allocating capital and whether they are returning money to their shareholders or not. And last but not least, we have the valuation. Because the best company could still be a bad investment if the price is too expensive. But for the scoring, I decided that I will not just look at the basic trailing PE multiples. Today, we are focusing on growth-adjusted and cash flow-centric metrics to also include the heavy capex spending that some of these companies have. And I will also look at one of my favorite valuation metrics, the forward-looking PEG ratio, to see how the price looks in relation to the expected growth. I will rank each of these categories from 1 to 5 based on how these companies rank relative to each other. So a 5 means that this company is leading its peer group in this category, and a 1 means that it's lagging behind. That gives us a maximum possible score of 20 points and breaks the group into 4 tiers. 17 to 20 is our elite S tier. 13 to 16 is A tier, 9 to 12 is B tier, 5 to 8 drops into C tier, and below 4 is D tier. So let's jump right in with the earnings quality. To grade this, we look at the free cash flow margins, the current operating margins, the year-over-year margin trend, and whether the management delivered a clean double beat on revenue and EPS in their last quarter. And to start it off, every single company in the Mag 7 beat the analyst estimates on both EPS and revenue in the last quarter. So a simple earnings surprise isn't what separates them. The real differentiation is how well they can translate the revenue to cash. And Nvidia operates in an entirely different zip code right now. It posted a 65.6 operating margin, which expanded by roughly 15% year over year. But the margins were in a dip 1 year ago, so this number is a bit misleading. When we look at the Q1 and Q3 from last year, the operating margins still expanded by 5% though. Google and Tesla could also both grow their margins by around 2%, while the rest only had a small growth or, in the case of Meta, even a small decline. For the free cash flow margins, I am looking at the last 12 months because they fluctuate pretty much quarter over quarter. But here, Nvidia also has by far the best cash conversion with 47%. And by the way, Nvidia is shown as the second quarter here only because the quarter ended in April while all the rest ended in March. So it fell into the second quarter instead of the first. Apple comes in second here with growing free cash flow margins, while the free cash flow margins of our hyperscalers are even declining. For Amazon, it has already reached even negative values. But this is no reason to worry, because it just shows the insane amount of capital these companies are spending to build up their data centers. And these spendings are eating up the cash flows. So when we look at the overall picture, The first thing that stands out are the high margins of Nvidia that could also grow the quickest, even if we account for the margin dip they had exactly 1 year ago. So they get 5 points without a second thought. Microsoft and Apple follow closely behind with 4 points each. Microsoft because they have the best operating profitability after Nvidia with a growing 47.3 and a still good free cash flow margin. And Apple because they can turn 28.6% of their revenue into cash, which shows that they still have the premium pricing power. They are also the only ones beside Nvidia who could grow the free cash flow margin meaningful over the last year. Then we hit the middle of the pack, and this is where the first cracks are showing. Meta and Google both get 3 points here, but for different reasons. Meta because their decreasing operating margin is at least a yellow flag, even though they still show good numbers otherwise. And Google because their free cash flow margin declined almost as quickly as Meta's and is already on the lower end of our Max 7. And then on the bottom, we have Tesla with only 2 points because their margins are in general much thinner than the others, and Amazon with only 1 point. Even though they still have 30% operating margin, they could grow it less quickly than Tesla over the last year, and they are the only company that already has a negative free cash flow margin, although I think this will change soon if the capex cycle continues. So after the first category, we have Nvidia in the lead with Apple and Microsoft close behind. Amazon is currently the last one, but this might change soon. Because next, we look at how these companies are expected to grow over the next 2 years. And this might shift our entire order. Now, growth is usually where the market narrative takes control, because it's easy to attach a nice story to high growth rates. But today we aren't looking at the backward-looking historical numbers, but the forward revenue and EPS growth over the next 24 months, and whether that growth is accelerating or slowing down compared to the last years. Let's start by looking at the total revenue. The first thing that stands out here is that Amazon has by far the highest revenue in absolute terms. But despite this, they are still growing nicely and steadily. Apple is currently still in second place, but their slow growth has allowed Google to catch up. By the end of the year, Google should even overtake Apple in absolute numbers, even though the revenue growth of Apple is also expected to pick up speed a bit. Nvidia has by far the steepest curve of them all and is climbing the ranks from the bottom up. They have already surpassed Tesla in total revenue and should also surpass Meta and Microsoft over the next 2 years. And speaking of Tesla, they are just recovering from negative growth, but the growth expectation for the next 2 years is also still pretty low. The EPS picture looks very different in terms of absolute numbers, but the growth trend is pretty similar in general. Here, Meta has by far the highest value in absolute numbers, and they are also still showing exceptional growth. Tesla is also growing pretty quickly here, but again, this comes after several years of decline and from a very low starting point compared to the others. But Nvidia takes the crown with the quickest growth again. That is also why they get another clean 5 points. Yes, its growth is technically decelerating compared to the triple-digit quarters of the past year, but they are still growing pretty much double the speed than all the other companies. And when you are growing the already biggest business on earth in terms of market cap by over 40% per year, even the slowing growth is not enough to push you from the top spot. Right behind them are Meta and Microsoft with 4 points each. Meta's numbers are perfectly aligned. 22.5% forward revenue growth and 21.6% forward EPS growth, with the trajectory slightly accelerating. And Microsoft as the quiet execution machine. It is looking at 16.7% revenue growth and 18.9% EPS growth. And crucially, both of these metrics are still actively accelerating. This shows that the commercial cloud and AI integration are still scaling up right now. Alphabet takes 3 points due to mixed signals here. Its forward top-line growth looks fantastic at 19.5% annually, but its forward EPS growth drops down to 13% over the next 2 years. This deceleration on the bottom line tells you exactly how much its aggressive infrastructure build is eating into their near-term income. At the lower end, Amazon and Tesla pull in 2 points. Amazon's growth, even though it's still in the double digits, is looking slowed compared to the hyperscaler peers, with bottom line also decelerating. Tesla shows a different kind of mismatch. Its forward revenue growth is flat at 13.7%, but forward EPS growth is pretty high at 24.6%. And both come from a very low and recently declining starting point. And don't mistake the bottom line jump for a sudden recovery in vehicle demand. That EPS growth is almost entirely driven by aggressive internal cost restructuring and headcount cuts, not the operations. Apple lands at the absolute bottom of the category with only a single point. It's the slowest company in the entire race, and even though its growth trajectory is technically accelerating, it simply can't match its other megacap peers. So in our ranking, Nvidia extends its lead to a perfect 10, while Microsoft quietly breaks away from Apple to claim the second place spot. But growth alone means nothing if you are destroying the balance sheet to get it. So next, we will look at the third category, which is the balance sheet and how much money these companies return to their shareholders. In this category, I am grading these companies on net debt to EBITDA and total shareholder yield, which combine both share buybacks and dividend payments to show you exactly how much cash in total these companies return to their shareholders. The balance sheet for all of these companies is still pretty clean. Tesla stands out here with the best balance sheet and huge cash reserves that push the net debt to EBITDA well into the negatives. All other companies are pretty close together and more or less at zero net debt. Some a bit above that, some a bit below. But this is where Apple makes a move and secures 5 points. Not because they hold the largest net cash position, but it completely dominates the group with a 2.2% total shareholder yield. When it comes to pure capital returns, nobody comes even close. This comes from the massive buyback yield of over 1.8% recently. They have used the last years and especially the dip of their stock price in 2025 for massive share buybacks. Microsoft and Alphabet follow with 4 points each. Both are absolute financial fortresses with negative net debt to EBITDA, and both are returning a significant amount of cash to their shareholders. For Alphabet, that mostly came from share buybacks on a massive level. But even though they still have an active share buyback program running, I wouldn't count on them keeping up this rate with their rise of capex. Nvidia and Meta walk away with 3 points each. Nvidia's balance sheet is pristine at negative 0.4 times net debt to EBITDA, but their shareholder yield is just 0.86%. Meta sits effectively debt-free and offers a healthy 1.2% yield. But they have already paused their share buyback program to focus on capex, and the tiny dividend yield won't make up for the buyback yield that will fall away shortly. Now, for the last 2 companies, the picture doesn't look so nice. Amazon takes 2 points. They have the highest debt rating of these companies and a neglectable shareholder yield. But Tesla has the worst performance of the group with only a single point. Yes, on paper, the negative net debt to EBITDA of minus 3.3 times looks great. But this ratio is completely warped. Because their EBITDA has declined for several years already, which in turn pushes their net debt to EBITDA value higher. So what looks great on paper is actually an operational red flag. But the real red flag is its shareholder yield of negative 0.08. Tesla isn't returning any capital to you, on the contrary. Its stock-based compensation is actively diluting their shareholders. So in our scoreboard, Nvidia holds on to the lead with 13 points, but the distance is shrinking, with Microsoft sitting right on its shoulder at 12 points. But then it gets interesting. Because Apple, Google and Meta are all tied for third place with 10 points, while Amazon and Tesla are tied for the last place with 5 points each. So we have 3 companies tied at 10 points, and the valuation is about to decide this pretty close race. Now, if you like this kind of objective stock analysis that filters out the hype and focuses entirely on the fundamentals, hit subscribe. I post 1 to 2 of these data-driven breakdowns every single week. So the valuation will decide the final winner. And this category might change everything because I'm not using the lazy, backward-looking trailing PE ratios. Instead of the market cap, I'll be using the enterprise values because these account for the massive and uneven cash piles and give us a better direct comparison. I will also use the forward-looking metrics again because, after all, we want to see which of these companies is the best investment going forward. So let's start with the late-stage drama. On surface multiples, Meta looks like the undisputed steal of the century. It trades at the lowest forward EV to EBITDA of just 10.3 times. That is exceptionally cheap for such a dominant digital ad monopoly. But if we look closer, Meta's forward enterprise value to free cash flow is negative 143 times. That negative value means that Wall Street expects Meta to generate negative free cash flow over the next 12 months. So the cash coming in from operations is completely swallowed up by its massive AI data center capex cycle. And we have the exact same story for Amazon, which shows a cheap 30.3 times EV to EBITDA, but an ugly negative 563 times forward free cash flow multiple. And a cheap EBITDA multiple is a bit misleading if the business burns more cash than it keeps. So both Meta and Amazon get hit by 2 points, breaking the tie and knocking Meta clean out of the top 3. But it could be worse. Just look at Tesla. They sit in their own universe of overvaluation and only get a single point. It trades at the forward EV to EBITDA of 95.3 and a PEG ratio of 16.7. Usually a PEG ratio of around 1 signals a fair valuation for the growth. And in the case of Tesla, I just don't see any fundamental justification for those high numbers. That leaves Apple and Alphabet, who both walk away with 3 points. But they approach valuation from different angles. Alphabet gives us an incredible growth-adjusted score with a PEG ratio of just 0.9. But its aggressive infrastructure spend pushes its forwards EV to free cash flow to the highest valuation of this bunch. Apple is exactly the opposite. Because its business doesn't require the same intensive server capex, it prints a clean and positive forward EV to free cash flow multiple of 31 times. The second best in the entire group, which they could also keep pretty stable over the last years. But because its growth is slow, its PEG ratio is with 2.2 also pretty high. Microsoft secures 4 points to lock in its position as the quiet overachiever of the tech sector. Its forward EV to EBITDA is pretty attractive at 13.7 times and its forward PEG ratio is a rock solid 1.1. So even though its AI build-out also pushes the forward EV to free cash flow to 68 times, it's not as high as our other hyperscalers. And while many think that Nvidia is overvalued, the actual data says the exact opposite. Nvidia takes a perfect 5 points again with the cheapest valuation overall. Think about how counterintuitive this is. It trades at a forward EV to EBITDA of 17.4 times, which is lower than Apple or Alphabet. But the killer metric is its forward enterprise value to free cash flow, which sits at just 22 times. That is the lowest, cleanest, positive cash flow multiple in the entire Max 7. And when you adjust the stock price for its growth, you get a best-in-class forward PEG ratio of 0.6. Nvidia isn't expensive. On a growth-adjusted, pure cash generation basis, it is actually the cheapest stock in the group. So when we look in the final scores, Nvidia dominates the field at 18 out of 20 points. Microsoft takes a clear second at 16, while Apple and Alphabet finish in a tie at 13. Meta is close behind them at 12 points. Amazon and Tesla are quite a bit behind the others with 7 and 6 points. I am actually quite surprised by these results. I would have thought that Amazon and Meta are higher up in the ranking and Apple a bit lower. But now that the numbers are in, let's look at how this translates into our investment tier list. The first good news is that none of these companies are in D tier. But both Tesla and Amazon go directly to C tier and are placed last. For Tesla, the story is pure fundamental deterioration. Shrinking EBITDA astronomical value multiples, and active shareholder dilution. Amazon, on the other hand, isn't a broken business, but right now, it's operating like a capital-heavy utility. It's growing the top line, but the massive cloud infrastructure bill means that it isn't letting any of the cash drop into actual free cash flow for investors. Meta is the only company in B tier and just barely missed A tier with 12 points. Their core growth and earnings quality are great, but management's decisions to aggressively outspend the market on AI infrastructure means that their forward free cash flow yield is completely wiped out. It's a high-quality business trading at a highly deceptive multiple. A tier is pretty crowded with Alphabet, Apple, and Microsoft. Alphabet gives you the better growth-adjusted value with its low PEG ratio, but forces you to swallow massive cash-burning capex headwinds. Apple, on the other hand, gives you a clean, reliable free cash flow profile, but you are paying premium multiple for low double-digit growth. Microsoft stands out here because they just barely missed S tier with 16 points. It didn't win any individual category, but it also didn't show any single fundamental weakness either. And that just leaves one company for S tier, which is Nvidia. They clearly take the lead and win 3 out of 4 categories with the highest margins, the fastest forward growth, and a forward free cash flow multiple of just 22 times. So, what does this list tell us exactly? To sell everything and buy Nvidia instead? No, absolutely not. But while the narrative is often that buying Nvidia at these levels is a dangerous momentum trade, the data says the opposite. It has the highest margins and the fastest growth expectation, and it all comes at a still very decent valuation. So with Nvidia, you aren't buying hype. You are buying the most efficient cash printing machine in corporate history at a lower forward cash multiple than Apple. So if you want to invest today based on pure financial execution, Nvidia and Microsoft are the clear structural standouts after the last earnings season. But keep in mind that this tier list is purely based on the financial performance. We didn't look at the mode or the quality of each business. And because I used the forward-looking metrics to see what the market's expectation is, it is not chiseled in stone and could also change. The biggest risk to the specific order in the tier list that I see is the hyperscaler capex cycle. Because Nvidia sits on the exact opposite side of this spending than Amazon, Google, Microsoft, and Meta. They are the ones who directly benefit from the spending that actually hurts all the other companies. So if the capex growth comes back to more normal levels, which it will eventually, it will hurt Nvidia the most while at the same time help all the others. So it could flip the tier list on its head. But as always, that's just my opinion. What about you? Do you agree with this tier list, or which of these 7 companies is your personal S tier? Let me know down in the comments. And if you now would like to dive deeper into the current financials of Google to see why I think that they currently have the best business model of all Max 7 stocks, watch this video next. And this is no financial advice, so please, before investing, do your own research and only use this video as a starting point for your own analysis. That being said, thank you so much for watching, guys, and see you in the next video.